Hey, what's up, everyone? Hopefully, you're having a good day. My name's Andy. My channel's Finding Value. Today, we'll go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what people are sharing. If you want to follow me, it's at Finance on Twitter. If you want to join our community, finding-value.com. That's where I dive deeper into all these topics, looking for potential investment opportunities. I am a long-term investor. I do not play the short-term market movements and take profits in the short term. I identify good undervalued opportunities to ride through this next commodity bull market. So that's what my strategy and objectives are. If that resonates with you, if you want to learn how to do it, definitely sign up. Take a look at how I do it. Take a look at my strategies. Take a look at the question and answer sessions that we have posted on the website. And right now, we are running a discount. Special is the discount code. Special. You get 50% off the first month on the monthly membership, and you get a larger discount on the yearly membership if you'd like to sign up for the yearly membership. So coming on down, compounding quality, one of the best businessmen in the world, Jeff Bezos. So let's take a look real quick. It's all about the long term, and that's what I have realized when looking backwards at different strategies that I should have deployed when I was a new investor. If I was thinking more on the long term, I would have had many 10, 20, 30 baggers easily since the beginning of my investing in about mid 2000s. I knew the good companies. I invested money in those companies, and my biggest downfall is I didn't hold long enough. Period. Like, that is not questionable. I had great judgment. I had great entry points. And my biggest shortfall was not thinking long term enough. It says when you think on the long term, you have a big advantage compared to those who don't. Bezos was willing to make investment decisions in light of long term market leadership rather than short term profitability or Wall Street reactions. I still made money. I just didn't make as much money as I could have if I adopted a more long term strategy, which I have. Coming down, a competitive advantage is essential. Online selling is a scale business characterized by high fixed costs and relatively low variable costs. This gives Amazon a huge competitive advantage as it is very hard for smaller e commerce companies to compete with them. It's one of the key reasons why Amazon is so successful. Be obsessed by your customers. Customer obsession is the core of Amazon's success. Amazon has always had the objective to build the Earth's most customer-centric company. You know, there are so many companies out there that I would invest in, but they're just private. Chick-fil-A and In-N-Out. I see those places busy all the time. Now I'm just thinking, and they are always packed. They just rip. It would be such easy money makers. Focus on organic revenue growth. Top line growth is the most preferred source of growth. Only invest in companies which manage to grow their revenue organically at an attractive rate. Over the past 15 years, Amazon grew its revenue with 26% per year. Good investing and good business are synonymous. When you invest in good businesses, great investment results will follow eventually. Free cash flow is king. This is something that I learned over the years. It says earnings don't determine the value of a company. The present value of future cash flows does. In his annual letters, Bezos stated multiple times that free cash flow is Amazon's key financial metric. And the other one, if you read it, our ultimate financial measure, and the one we most want to drive over the long term, is free cash flow per share. So when you're investing, that is probably the best metric to use to value the companies that you are looking at. It's free cash flow per share. And I've got some ridiculous setups in oil right now with free cash flow per share. And the compounded annual growth rates are all over 20% at $70 a barrel oil. And oil at $70 a barrel is incredibly cheap on a historical basis when compared to the Dow and when compared to gold. Advertising is the price you pay for having an unremarkable product or service. When you have a great company, the product will sell itself. You want to invest in companies that produce products or services customers love. Culture is everything. In the short term, valuation is the most important mover for the stock price. In the long term, free cash flow growth and the culture of the company is. Be cash favored and capital efficient. Bezos stated that Amazon is fortunate to benefit from a business model that is cash favored and capital efficient. They don't need physical stores, nor do they need a lot of inventory. A low capital intensity is key for quality companies, as this allows them to grow exponentially when they reinvest in themselves. Improve every single day. Every annual letter Bezos mentions, it's still day one for Amazon. Operational excellence means delivering continuous improvement in customer experience, driving productivity and margin efficiency. This should be the goal for every company. Focus on return on invested capital. That's your ROIC. Bezos has always had the long-standing objective of building the best, most profitable, highest return on capital long-term franchise. The ROIC is the most important metric for quality investors. The higher the better. And that is your net operating profit after tax divided by your total invested capital. So that is your return on your invested capital. Your ROIC is ultimately the return that you'll see over time. So if you keep piling money back into the company and what your returns are on your invested capital is generally what your long-term stock price appreciation generally turns out to be. So if you can grow your free cash flow per share and then the money that you reinvest back in has really good returns, you're golden. It's a really strong company. 12, don't focus on the stock price. And everyone focuses on the stock price so much, especially in the damn short term. Bezos stated that they don't celebrate a 10% increase in the stock price as much as they celebrate excellent customer experience. In the end, the fundamentals of the company is all that matters. 13, secular trends are your friend. Treat external trends as your friend. If you fight them, you're probably fighting the future. Embrace them and you'll do great. And those are the secular trends that I focus on. That's so we have the three pillars. Technical analysis, which identifies kind of when a secular trend is turning. We've got market conditions, which is the cycles. And then ratios, which can tell you what's cheap and what's expensive. Those are all three of those are there to identify secular trends. But secular trends, they don't play out like most people think. A secular trend is a 15, 20, 30, 40-year period trend. The last trend, looking backwards, was from 1982 when interest rates peaked to the bottom of 2020. That's a secular trend. That is where financial assets will do incredibly well, especially bonds and the stock market. We've broken out of that downtrend into an increasing interest rate environment which is more friendly to commodities and energy and some of these other plays that people aren't looking at. 14, don't be afraid to fail. Failures are crucial to becoming successful. Plant seeds daily. Good companies should reinvent themselves every single day. 15, invest in durable companies. A great business has four characteristics. Customers love it. It can grow to very large size, has strong returns on capital. That's your returns on capital. And it's durable in time with the potential to endure for decades. When you find a company that ticks all the boxes, don't just swipe right, get married to it. And that's all that there is from that one. So oil to Dow and oil to gold doesn't look bearish, is what I said. Obviously, I'm joking. It looks pretty bullish to me. These are important trend changes, and these are secular in movement. So when I take a big picture view of crude oil versus Dow Jones, we've got a bottom here in 2000 that ran up, hit the top. And then we've got a falling wedge, 1, 2, 3 hump consolidation, a false breakout, came up, broke out, consolidated, and we're looking to break out again. This guy says doesn't look bullish neither. It says looks like it's trying to turn bullish in my opinion. We zoom in, big green candlesticks, small red candlesticks. That is generally a start, potentially, of a move higher, where crude oil could outperform Dow Jones. Well, why does that matter? It's a secular trend. I bought really close to the bottom in 2020. I didn't buy the total bottom. I waited for it to come back up. And I bought it in the corner of this falling wedge. And then I'm buying again in the corner of the wedge. And what most people fail to do is they get bearish when things go down, when you should be getting bullish because your risk reward opportunity is getting better. Also, it's a falling wedge. And even if you get a false breakdown, it would be an opportunity to buy it because we're so cheap. And that's where your confidence in the bull market comes from. It comes from these charts. At least that's where mine comes from. And it comes from the fundamentals of the sector. And the companies are just ridiculously cheap. And they're free cash flowing like a beast. This is crude oil versus gold. 1, 2, 3, falling wedge, breakout, and then we've got another squeeze into the corner here, another falling wedge. And there's the falling wedge, big bullish breakout here, and then we've got small little down days. We're getting close to potentially breaking to the upside. Now, this doesn't mean that we break to the upside and necessarily run. We might just break to the upside and still chop sideways for 6 months. So it's not about getting rich quick per se. It's about the big trends shifting. And what happens is the big trends shift and then they take a little bit of time and then they'll run eventually. And I'm there to make the big money. The big money is sizing the big move correctly. But that doesn't mean it happens immediately. So what most people will probably do, I'm just guessing, they're going to say, okay, that's great, but I want to get rich quick. It's like, okay, go over to crypto, go roll your dice on the roulette table, or I guess not rolling the dice on roulette, but roulette doesn't have the dice. But go play roulette, go play whatever else gambling and see if you win. That's fine if that's what you want to do. But my approach is identifying these big secular trends, buying when things are cheap, and then just holding on. I think crude oil is it's the second cheapest time it's ever been since the 1800s. It's probably one of the best opportunities. It may not be the best in 2025, but markets are forward looking. They look forward 12 to 18 months, and I think 2026 is going to get pretty tight. So markets here are probably going to bottom. We'll start working our way on up slowly. 2025 might be a good year for the companies if we get 80, $90 oil. And then 2026, we'll see what the balances look like. Here's Larry talking about, so he says, between 98 and 2004, I blew up 2 or 3 trading accounts and decided to give up on trading and investing a few times. After a few months off each time, I kept coming back and reading more and more, trying to figure it out. More trial and error with real money, trying to find what worked for me. I discovered Jesse Livermore sometime in 06, 07, and when I read this one page, it changed the course of my trading and investing journey. Most of my personal mistakes were summed up on this one page. My biggest takeaway was that I didn't have to consistently be doing something every single day and trading in and out of my positions. My second biggest takeaway was that the trader is always the weakest link in any trading system. There is no one size fits all. It takes time and experimentation with real money to find a plan that works for you or a strategy. Here's the things from Livermore that he takes to heart here. It was never my thinking that made the big money for me. It was always my sitting. Men who can both be right and sit tight are uncommon. The market does not beat them, they beat themselves. Disregarding the big swing and trying to jump in and out was fatal to me. So what I do, and I'm like a disciple more so towards Buffett now than more towards Buffett than Livermore. Livermore went bankrupt multiple times. Yeah, he went bankrupt multiple times. They called him the boy plunger. He'd use a lot of leverage, just put all his money in like one trade, make either a whole bunch of money or go bust. So I mean that's kind of what Livermore did. But he had a lot of good sayings, and there's a lot of things that pertain to everyone in making money. But I think Buffett has definitely made more money more sustainably and just has grown it over time. So I think his strategies are far better than Livermore in terms of making money sustainably and not going broke multiple times. So I take a little bit of both. I take a little bit of Livermore. I take a little bit of Buffett and those types, and I apply it, or try to at least. Joys of compounding, he says, we should not aim for the highest possible returns in the shortest period of time, but rather we should seek above average returns over a long period of time with the lowest possible risk. And that is completely true. You want to look at how do you get the largest returns for the longest time with the least amount of risk. I would say the majority of people want the highest possible returns in the shortest period of time. The problem is your probability of success of getting it is a lot lower. So they get frustrated and then they become a gambler. The gambler mentality is they lose. So let's say they lose 50% of their money. But what they do is they continue to put it down on high risk bets, trying to get that money back. And eventually they lose it all. So it's better for most people, I would say the majority, to look for returns that are above average for long periods, but also doing it in a way where you don't blow up. That's the lowest possible risk. So you want to manage risk, and a lot of the times you manage it by your entry points. That's the whole reason I came up with the 3 pillars is to manage risk. It's all risk mitigation. And then you have to sit in it. You're still going to get volatility. You're still going to have to ride through big swings. But that's what it takes to get 10, 20, 30, 40 times your money. you will experience 40, 50, 60% pullbacks. Like that is, it will occur. The question is, can you ride through it? Do you position size it properly? Rashad, I like this guy. Every chart I see, he has this going up. He has silver going up and gold going up. Every chart. I just wanted to share that. Kobayashi letter. He says U.S. existing home sales are set to close at 4 million in 2024, marking the worst year since 95. Sales are set to be even lower than during the 2008 financial crisis. The lack of demand for existing homes comes as home prices have jumped over 50% since 2020. Over the same time period, mortgage rates have nearly tripled, making affordability even worse. The average rate on a 30-year mortgage is up 100 basis points since September alone to 7.1%, despite the Fed cutting rates by 100 basis points. The U.S. housing market is frozen. And that might have something to do with the debt situation that America is in. But people will say, oh, well, demand and sales is low. Yeah, but it's just a bunch of people who can't afford anything. I mean, that's really what it comes down to is affordability. And the inventory is still super low. So it's not like 2008 where home sales plummeted, not because of affordability, but because all of the loans went bust and nobody could buy because now all the people that purchased with crappy loans gave it all back. It's a totally different situation. What do you think is currently the number one most undervalued stock in the market? I wanted to talk about this. So the way that you value a company, it's you do a net present value calculation of your free cash flow out in the future. And in order to be the most undervalued stock in the market, in actuality, I'm not talking about hypothetical. I'm just saying to actually get this right, this is what you have to look at. So in the market, stocks are priced off of future cash flows. And what you're making a bet on is that the market currently has the wrong future cash flow, future values. And that is where the debate will lie. So when you discount everything back, you'll get a net present value of a business, and that net present value versus today's market cap has the largest discrepancy between the two. So you're betting that the market has mispriced future cash flows of the company. So then the question is, what company, when you look 10, 20 years out, what company has the lowest mispriced cash flows to what the actuality will bear out? In my opinion, it's a commodity company. And it deals with future cash flows that people don't care about today versus the actuality of those cash flows 10 to 20 years out. So when I look at everything, I think the biggest market dislocations today, with risk taken into consideration, I would say oil and energy service companies are the most mispriced in the market. You could also state that potentially coal could be too, because I think we're going to have major problems in the future in energy. And I don't think any of that is priced in the market. And the reason I chose coal and oil is because they're undervalued today, given really cheap prices in both of them. And I also think that the commodity itself is undervalued. So it has huge. So with the underinvestment in oil and coal, and with all of the, we'll call it carbon crap and emissions, I think we have underinvested in energy in general. I also think that we can't ramp up alternatives fast enough. So, given the profitability of existing companies in coal and oil, and given the current situation where renewables, I think, will have mineral constraints and power transmission constraints, it sets up the largest opportunity in oil, natural gas, and coal because we have companies with the infrastructure in place which are currently making lots of money, are incredibly undervalued currently, and we've got commodities, those commodities that are cheap. We also have an increasing interest rate environment where those commodities thrive under. Financial assets do not do as well over the next 10 to 20 years, in my opinion, compared to hard assets. And the market has it completely mispriced. So I think that the number one most undervalued stock in the market is in commodities. Now, it could also be a precious metals company, perhaps, if we have currency problems. And if silver were to go to multiple hundreds of dollars, we could see maybe some silver company or something be one of the most undervalued stock in the market today, given its future cash flows over the next 10 to 20 years. And that's kind of what we're making our bets off of. We're making our bets off of future cash flows that we don't know for sure. And that's where we hedge ourselves. We kind of grab a couple in different sectors, and whatever plays out, we get. So I don't think it's Nvidia because they are way overpriced. They're expensive. And I think there's going to be problems. I think energy is going to be a limiting factor for artificial intelligence and these data centers. So I think that energy will be the biggest play of AI, not AI itself. So Milton says inflation is taxation without legislation. Do you agree with Milton? Yes, I do. Americans now need to work 110 hours a month to be able to afford their mortgages. Now, my mortgage is not very big, and I need to work approximately 0 hours because I have dividends from my assets that pays my mortgage, and my mortgage is really low. So that's the whole key to everything. The key to everything is to build your asset base, get your cash flows up, your free cash flow up, and run your portfolio like it's a business. Get your cash flow up, 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 reinvest cash flow, pay off stuff with dividends, and play it that way, perhaps. Then you also become more resilient because now you've got cash flows from companies that are paying you. And let's say you've got 40 different companies paying you money or 30 different companies paying you money. That's resiliency. What if they're indexed to inflation, the commodities? You go through a large commodity boom, now your income goes up with inflation. It's kind of indexed to inflation. So you thrive under an inflationary condition. If you're a single based income working a 9 to 5, you're probably not going to keep up with inflation. You also have large risk with only one source of income. So what I've done is I've tried to diversify my sources of income to make sure that my mortgage never goes unpaid. I also have a low mortgage payment. It's very low. So that's another thing that I really wanted to do. But that's what I've got for today, guys. We'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.